Welcome to the deep dive. Today we're getting into something pretty fundamental if you follow the stock market. Market efficiency.
Right.
You've probably heard people say, oh, that's already priced in. We want to unpack what that actually means for you.
Exactly. And for you, our listener, the learner, who wants to get up to speed quickly, but, really understand complex stuff without getting bogged down, this deep dive is basically your shortcut.
Yeah, a shortcut to understanding the efficient market hypothesis, the EMH, especially thinking about the U.S. stock market right now in 2025.
Mm-hmm. We've gone through, well, quite a bit of research, projections too. Our mission today, explore the core ideas of EMH, look at what's shaping the U.S. market now, and really dig into that claim. Is everything really priced in?
Okay, let's do it. So EMH, it's all about how fast and how accurately new information gets reflected in stock prices, right?
Spot on. It's key for anyone investing, or even if you're just curious about how markets tick.
So to wrap our heads around it, we need to look at the different forms, or maybe levels, of market efficiency. It's like how much info is already in the price.
Precisely. Think of it in 3 stages.
Yeah.
The first level, that's weak form efficiency.
Okay, weak form. What's that mean?
It suggests that all the past trading information,
Yeah.
historical prices, trading volumes, all that stuff is already reflected in the current stock price.
Ah, okay.
And the big implication here, well, if the market is weak form efficient, trying to predict future prices by looking at charts of past prices, technical analysis,
Yeah.
it's probably not going to work consistently.
Yeah.
It's often described as a random walk. Where the stock went yesterday doesn't really tell you where it's going tomorrow.
Gotcha. Like flipping a coin, the past flips don't predict the next one. Okay, so what's the next level up?
That takes us to semi-strong form efficiency. And this is where it gets really relevant for most investors, I think.
How so?
This level argues that current stock prices reflect all publicly available information.
All public info. So like news reports, company earnings announcements, economic data.
Exactly. Analyst ratings, macroeconomic forecasts, industry trends, anything you can find out in the public domain.
Okay. And the implication of that.
Well, if the market is semi-strong efficient, it means neither looking at past price charts nor digging into a company's financials. Using only public information that's fundamental analysis will consistently let you beat the market.
So no secret edge from reading the Wall Street Journal really carefully.
Basically, yeah. The idea is that edge gets competed away almost instantly. The CFA Institute, for example, they generally lean towards this view for developed markets like the U.S., though they always add some caveats.
Right. So for you, the learner, this means maybe be a bit skeptical if someone claims they can consistently get you huge returns just using public data.
It's definitely something to keep in mind.
Okay, so weak form. Past prices don't help. Semi-strong. All public info is baked in. What's the absolute top level then?
That brings us to strong form efficiency. This is the most extreme version.
Extreme how?
It suggests that everything, all public info, and all private insider information is already reflected in the stock price.
Wow. Okay, but does that actually hold up?
Oh, no, not really. The real world kind of punches holes in that one.
Yeah.
Think about insider trading. The fact that it happens, it's illegal, and people can make huge profits from it before getting caught.
Ah, right.
That clearly shows that private, non-public information does have value and isn't always already priced in. If strong form were true, insider trading wouldn't be profitable.
Makes perfect sense. There wouldn't be any secret information advantage.
Okay, so if these are the forms of efficiency, what are the underlying conditions? Like, what does the theory assume needs to happen for a market to be efficient?
Good question. EMH rests on a few key assumptions. They're kind of ideal conditions, First, it assumes rational investors.
Meaning everyone acts perfectly logically all the time. Not quite perfectly, but on average, investors are assumed to process information correctly and act in their own self-interest to maximize their returns. No widespread emotional decision-making, ideally.
Okay. Rationality. What else?
Second, information availability. The idea is that relevant information is easily and cheaply accessible to all market participants at roughly the same time. A level playing field for info.
Right. No hidden info corners.
The third, instantaneous price adjustment. When new information hits the market, prices are assumed to adjust to reflect it immediately and accurately, without over or underreacting.
Like a perfectly efficient machine.
Kind of. And fourth, ideally, no transaction costs, no brokerage fees, taxes, or other costs that would prevent investors from acting on information.
Which we know isn't true in reality.
Exactly. And finally, a large number of participants, lots of buyers and sellers competing, which helps drive prices towards their correct value.
Okay, but like you said, the real world isn't this perfect model. People do get emotional. Trading does cost money. Information isn't always free or easy to get. How do these real world frictions mess with market efficiency?
They mess with it significantly. These frictions are precisely why efficiency isn't perfect. Irrational behavior like panic selling during a crash or getting overly exuberant during a bubble that definitely pushes prices away from fundamental values.
Creates openings, maybe?
Exactly. It creates potential mispricings and transaction costs. They can stop those rational investors, the arbitrageurs, from stepping in to correct those mispricings because the cost of the trade might eat up the potential profit.
Makes sense.
And other limits to arbitrage, too. Like sometimes it's really hard or expensive to bet against a stock, to short sell it, even if you think it's overvalued. That can let overpricing stick around for longer than it should.
Okay. So if we buy into EMH, at least partially, maybe the semi-strong form, what does that mean for us, for you, the listener, trying to invest?
The implications are pretty big, actually. If you accept that the market is largely efficient, especially in that semi-strong sense for public info,
Yeah.
it strongly supports passive investing. Just buying and holding a broad market index fund or an ETF, instead of trying to actively pick individual stocks you think will outperform.
Because picking winners based on public info is, theoretically, a losing game long term.
Or at least a very, very difficult one to win consistently after costs. It also suggests your focus should maybe shift towards risk management and diversification. Spreading your bets, matching your risk tolerance, rather than chasing elusive market-beating returns.
What about those active fund managers charging high fees?
Well, yeah, it definitely makes you question the value proposition of high-fee active management.
Yeah.
If all the public information is already in the price, what special skill or information are you paying those higher fees for? It's a fair question to ask.
It really is. So thinking about the U.S. market today, 2025, is it efficient? Is it just a simple yes or no?
Oh, definitely not simple. It's really not like a light switch, efficient or inefficient. It's much more like a spectrum.
A dimmer switch.
Yeah, that's a good analogy. The level of efficiency can change. It can vary across different stocks, different sectors, and definitely over time, depending on market conditions.
Interesting.
And there's actually a newer idea, the adaptive market hypothesis, or AMH. It views efficiency as something that evolves, kind of like a biological ecosystem adapting to its environment. Efficiency waxes and wanes based on competition, investor behavior, and market events.
Okay, so it's dynamic. Let's zoom into 2025 then. What's the landscape look like now? What forces are pushing that dimmer switch up or down for the U.S. market?
Right, connecting EMH to now. Well, the economic picture for 2025 is mixed. We're seeing projections for moderate, maybe somewhat resilient growth, but there's also talk of a potential slowdown, a pause, maybe in the stock market's climb.
And inflation is still a worry.
Definitely. Sticky inflation is a major theme. And that leads to uncertainty about interest rates. Will they stay higher for longer? All this uncertainty makes it harder for investors to agree on what companies are actually worth.
Because the future cash flows are harder to predict.
Exactly. And when there's more disagreement and uncertainty, you can get more price volatility, potentially less efficiency, as different people reach very different conclusions based on the same fuzzy information.
Okay, uncertainty is a factor. What about just how expensive stocks seem now? And market mood.
Valuations, yeah, by many historical standards, they look pretty elevated. But forecasts for 2025 performance are, frankly, all over the place. Some are bullish, some are cautious. What's really striking is how quickly sentiment can shift.
Like we saw with AI stocks.
Precisely. That huge run-up driven by enthusiasm followed by corrections. It shows how powerful narratives and, let's face it, sometimes hype, can temporarily disconnect prices from underlying business fundamentals. That's inefficiency in action, even if temporary.
And it's not just economics and sentiment, right? Politics, regulations, global stuff must play a role too.
Absolutely critical. Policy uncertainty is a big one. Potential changes in trade policy, immigration, government spending, environmental regulations, all these can impact different sectors and companies dramatically.
Tariffs, for example.
Tariffs are a classic example. They can disrupt supply chains, raise costs, affect profits. On the other side, you have regulatory efforts aiming for more transparency. Like updates to SEC Rule 605 are meant to give better data on how well brokers execute trades. Theoretically, that could boost efficiency.
But then you layer on geopolitics.
Right. And geopolitical risks feel particularly high right now. Conflicts, tensions between major powers. The uncertainty surrounding these events is the key thing. It can spike volatility and trigger those behavioral biases we talked about. Fear, herd mentality, making rational pricing much harder.
It feels like all these different types of uncertainty, economic, policy, geopolitical, they could just pile up and make investors feel like they're flying blind.
That's a real risk. When you have this compounding uncertainty, something's called Nishian uncertainty, where you can't even confidently assign probabilities to outcomes.
Okay.
Investors might just give up on deep analysis and fall back on mental shortcuts, heuristics, or just do what everyone else seems to be doing. Herd behavior. That definitely gets in the way of efficient pricing.
And are there specific market trends or divergences that are testing efficiency right now?
Yeah, we're seeing potential divergences. Maybe U.S. interest rates move differently than Europe's. The performance gap between, say, AI leaders and the rest of the market, regional economic differences, how the market prices these potential gaps and whether arbitrage opportunities pop up and get closed quickly, that's a constant test of efficiency.
Okay, so keeping all that context,
Yeah.
the theory, the assumptions, the 2025 reality, and let's go back to that phrase, everything is priced in. How accurate is that, really?
Well, like we established, that statement really maps onto strong form efficiency. And the evidence just doesn't support strong form being true.
Because it is.
Several things. Profitable insider trading is Exhibit A, the persistence of certain market anomalies.
Like small stocks sometimes outperforming big ones, or value beating growth over time.
Exactly. The size effect, the value premium, momentum. If everything were perfectly priced in all the time, these systematic patterns shouldn't really exist or at least not persist for so long.
Makes sense. What else contradicts it?
The limits to arbitrage we discussed. It's not always easy or cheap to correct mispricings, so they can linger. And then there's the whole field of behavioral finance.
Right, proving we're not always rational economic robots.
Far from it. Our biases, overconfidence, loss aversion, confirmation bias, constantly lead to decisions that aren't perfectly rational, affecting prices. Even things like post-announcement drift, where a stock price continues to slowly move in the direction of a surprise earnings announcement for days or weeks afterwards that challenges the idea of instantaneous price adjustment.
Okay. But surely when people say it's priced in, they often mean public information, right? Because news seems to hit the market incredibly fast these days.
That's a really fair point. Colloquially, it probably is often used as shorthand for the rapid digestion of public information, more aligned with semi-strong efficiency.
And is the market efficient in that sense? With public info?
It's certainly much more efficient than it used to be, largely thanks to technology. There was a fascinating NBER working paper recently.
Oh, yeah. What did it find?
It looked at the impact of things like the SEC's EDGR database and XBRL tagging technologies that made company financial data way easier and cheaper for everyone to access and analyze electronically.
Okay.
And it found that these technologies actually weakened some well-known market anomalies that were based on accounting data.
Wow. So making public data easier to use actually reduced those predictable patterns.
Exactly. It implies that before these tools, even though the information was technically public, it wasn't fully priced in because it was too costly or time-consuming for many investors to effectively process.
That's a crucial insight. It's not just if it's public, but how usable it is.
Precisely. Accessibility and processability matter hugely for efficiency. And you're right. The speed of information flow today, with high-frequency trading, algorithms, it can create an illusion of perfect instant pricing.
An illusion.
Well, speed doesn't always mean correct interpretation. Algorithms might react instantly, but based on flawed logic or herd behavior. Behavioral biases still operate, even in a high-speed environment. And what's priced in is also relative, isn't it?
How so?
It depends on your access, your analytical tools. A big hedge fund with quant teams sees and processes things differently than a retail investor, and your transaction costs. That NBER study supports this. Leveling the playing field on data access moved the needle on efficiency.
Okay, so everything is priced in is definitely too strong a statement. Let's talk about the active forces really shaping efficiency in 2025. What are the big challenges and catalysts right now?
Okay, yeah, contemporary forces. First and foremost, we have to keep talking about behavioral finance. It's not going away.
Our irrational minds.
Right. Overconfidence, loss aversion, herding, anchoring bias, All these cognitive shortcuts and emotional responses, especially in a market with the kind of uncertainty we're seeing projected for 2025. Emotional decision-making could easily get amplified.
Leading to more mispricings.
Potentially, yes. Concepts like prospect theory, how we weigh gains and losses differently, or mental accounting, treating money differently depending on where it came from or what it's for. These are constantly influencing real-world investment choices.
Okay, so human psychology remains a huge factor. What about those market anomalies we mentioned? Are they still a big deal?
It's a moving target. Some recent research, like from 2024, 2025,
Yeah.
suggests that when you really stress test, many of the classic anomalies found in older studies using newer data and tougher statistical methods,
Yeah.
a fair number of them don't hold up as strongly or maybe disappear, which could mean markets are getting better at pricing those particular historical patterns.
So some efficiency gains there.
Possibly. But the same research often finds that even when some anomaly signals do seem to exist, professional analysts don't always fully use that information, or they incorporate it really slowly.
Why? Human limitations again.
Seems like it. Cognitive limits, maybe institutional inertia. It suggests that even if a potential inefficiency exists, the process of correcting it isn't always smooth or immediate. And of course, the big question is, will today's unique market conditions create new anomalies we haven't identified yet?
Always something new. Okay, what about the machines? High-frequency trading, HFT, friend or foe to efficiency?
HFT. It's definitely a double-edged sword. The pro argument is that these ultra-fast traders improve efficiency at a micro level. They compete fiercely to exploit tiny price discrepancies, which narrows bid-ask, spreads the cost of trading, and helps prices reflect new information nanoseconds faster. They are the ultimate arbitrageurs of tiny gaps.
Okay, sounds good. What's the con argument?
Critics worry HFT can worsen volatility, especially during stress. Think flash crashes. There are concerns about algorithmic herding lots of machines reacting the same way at the same time. And this idea of liquidity illusion, where the market looks deep and liquid, but that liquidity can vanish instantly if HFT firms pull their orders. Plus, some strategies might be seen as predatory.
So the net effect is unclear.
It's heavily debated. HFT isn't going anywhere in 2025. It's dominant. But whether its net impact makes the market more efficiently priced in a broader, long-term sense, or just faster and potentially more fragile, the jury's still out.
Okay, now the really big technological shift, artificial intelligence. AI in finance. How's that changing the efficiency game?
AI is potentially revolutionary here. Its ability to process absolutely massive data sets, news feeds, social media, satellite images, you name it, way beyond human scale.
Yeah.
And identify complex patterns, then automate trading based on those patterns. That could fundamentally alter information arbitrage and price discovery.
So could AI make the market more efficient?
In theory, yes. It could potentially make weak form efficiency stronger by finding and erasing subtle historical patterns, though any AI edge there would likely be competed away very fast. More profoundly, AI could boost semi-strong efficiency by allowing for much quicker, deeper analysis of all that public information we talked about.
Sounds almost like a path to perfect pricing.
Well, there's significant risks, too. Just like with HFT, there's the danger of AI-driven herding if many models use similar data or logic. That could amplify booms and busts.
And the black box problem.
Exactly. If we don't understand why an AI is making certain trades, it's hard to manage the risks. What if hidden biases or flaws exist across many systems? That could create systemic vulnerabilities. And there's even the risk of AI being used to deliberately spread false information to manipulate markets.
Scary thought.
It is. We're definitely in an AI arms race in finance now. Its net effect on efficiency, positive boost versus new risks is one of the biggest stories unfolding.
Okay, one more major force. The rise of the retail investor, often getting ideas from social media. How does that fit into the efficiency puzzle?
Hugely important factor. Technology hasn't just empowered institutions. It's made trading accessible and information, or maybe misinformation, widely available to individuals.
Platforms like Reddit, Twitter.
Right. They've become powerful engines for information sharing, but also for building narratives and driving sentiment. This can lead to intense herd behavior.
Meme stocks being the prime example. GameStop, AMC.
Absolutely. Those are textbook cases where collective sentiment, amplified online, completely detached stock prices from any traditional measure of fundamental value. That's a major, if perhaps temporary, breakdown of efficiency. Research confirms these feedback loops between social media chatter and meme stock volatility, clear violations of EMH.
So more people participating is good, but it also brings more potential for noise and bias.
That's the trade-off. democratization is positive in many ways. But if a large segment of the market is more susceptible to behavioral biases or following trends without deep analysis, it can impact price discovery and potentially increase inefficiency and volatility. And this trend looks set to continue, maybe even grow in 2025.
It really feels like an efficiency paradox, as you put it earlier. Technologies like HFT and AI could enhance efficiency, but also bring new risks like volatility or herding. Retail access is good, but can fuel sentiment bubbles.
That captures it well. The whole game of finding alpha market-beating returns is shifting. It's less about just reading standard financial reports better than the next person. Now it's more about using AI to analyze alternative data sets, trying to anticipate or exploit behavioral biases, or just being faster with HFT.
And that NBER study supports the idea that traditional sources of alpha are eroding.
It certainly suggests that alpha based purely on processing standard public accounting data is harder to come by, thanks to technology making that data easier for everyone to process.
You also mentioned meta efficiency. What's that?
It's thinking about the next level up. How efficient is the market at interpreting the interpreters? How well does it price the signals coming from AI models, from social media sentiment, from the analyst trying to make sense of it all? There's even a risk of model monoculture if too many players rely on similar AI, leading to correlated bets and potential instability.
And the paradox of transparency. More data, but maybe less clarity.
Yeah, we get ever more data disclosed, which sounds good for transparency.
Yeah.
But if the actual trading strategies, especially the complex algorithmic ones, become more opaque, are we just shifting the information asymmetry somewhere else? It's a real question.
Okay, so to ground this a bit more, what are some specific findings from recent research, say 2024 or 2025 studies, that illustrate these dynamics?
Sure, some recent empirical work highlights these complexities. One area is multifractality. Studies find U.S. stock returns aren't simple random walks. They have complex, time-varying patterns, especially during crises. This suggests efficiency isn't constant, supporting the adaptive market hypothesis.
Okay, what else?
The NBR paper on EDGAR XBRL we discussed is key, showing efficiency gains from processability of public data. Research on analyst behavior keeps showing they're slow to incorporate anomaly information, highlighting human limits.
Any behavioral findings?
Yes, studies continue to link behavioral biases directly to market reactions, for instance. How the S&P 500 reacts to macro news seems influenced by prevailing sentiment or biases, confirming psychology's persistent role.
And AI's impact.
Research on AI-driven trading is emerging. Findings often suggest a dual effect. Faster information incorporation, which helps efficiency, but also potentially more short-term noise and sharper, faster volatility spikes.
And support for that adaptive idea.
Yeah, studies looking at different markets and time periods often find evidence consistent with the adaptive market hypothesis, AMH, showing efficiency levels fluctuate with market conditions, competition, and events.
Okay. Let's try to pull this all together then. What's the main takeaway for you, our listener, the learner, about the U.S. stock market in 2025 and whether everything is priced in?
I think the core takeaway is this. The U.S. market in 2025 probably shows a dynamic, technologically supercharged form of semi-strong efficiency. Public information gets absorbed incredibly fast. But that efficiency is constantly being shaped and, frankly, sometimes warped by behavioral biases, the complexities and potential fragilities introduced by algorithms and HFT, and the significant, sometimes unpredictable influence of this large cohort of retail investors interacting via social media.
So the simple claim, everything is priced in, strong form efficiency, is just not accurate.
No, it's definitely an oversimplification and largely refuted by the evidence.
So it's not a static state. It's more like a constantly shifting landscape.
Exactly. It's an evolving dance between information, ever faster technology, and fundamentally human and now algorithmic psychology. That really fits the adaptive market hypothesis. View efficiency isn't a destination you arrive at. It's a process of continuous adaptation.
So for you, the learner, maybe the final thought is this. You're investing in a market where information travels at light speed. Yes, but it's filtered through human brains and complex algorithms. This creates both amazing opportunities and potentially hidden risks.
Right.
So how do you navigate that? Maybe it's about balancing how you use all that instantly available information with a deeper understanding of the forces, psychological, technological, that can cause prices to temporarily veer off course.
Continuous learning, critical thinking. They become more important than ever in this kind of environment.
Absolutely. And if you want to keep digging after this deep dive,
Oh, plenty of avenues. You could dive deeper into specific behavioral biases, explore current research on market anomalies, really get into the weeds on AI's impact on market structure and stability, or explore the adaptive market hypothesis in more detail.
lots to think about. Definitely not a simple priced-in world out there.
Not at all. It's far more interesting and challenging than that.